Hello, and welcome to today's webinar, Financial Literacy 2. Today, we'll be having a much more deep insight on everything needed for you to be a professional trading on the financial market. Financial Literacy 1 was a success, and we believe that you gained key points and values, mastering the basics of the market. Today, we'll be having an in-depth overview with Financial Market Literacy 2. Let's go. Next page, please. Today, we'll be looking at types of Forex market analysis. We're talking on technical, fundamental, sentimental analysis. Now, these are the three major types of analysis in the Forex market. Let's take a look at three ways on how you would be able to analyze and develop ideas to trade on the market. The technical analysis involves what happens totally on the chart. Fundamental analysis involves economic news events based on what happens in different countries' economy, while the sentiment analysis purely has to do with total and informable sentiments of each trader in different regions. Now, there's always been a constant debate as to which analysis is better, but to tell you the truth, you need to know all three analyses very importantly. It's kind of like standing on a three-legged stool. If one of the legs is weak, the stool will break under your weight and you will still fall flat on your face. The same holds true in trading. If your analysis on any of the three types of trading is weak and you ignore it all, there is a good chance that it will cause you to lose out of your trades. Next page, please. Now, a much more clearer understanding about technical analysis is that it is the framework in which Forex traders study price movement. That theory is that a person can look at historical price movements and hence determine the current trading conditions and potential price movements. The main evidence for using technical analysis is this. Theoretically, all current market information is reflected in price. If price reflects all the information that is out there, then price action is all one would really need to make a trade. Now, have you ever heard the old adage that history tends to repeat itself? Well, that's basically what technical analysis is all about. If a price level held as a key support or resistance in the past, traders will keep an eye out for it and base their trades around that historical price level. Technical analysts look for familiar and similar patterns that have formed in the past and will inform trades, ideas, believing the price will act the same way that it did before. Next page, please. Now, we have a chart on technical analysis. We notice that price had trouble breaking these levels. Charts allow us to see where a market has gone, which gives us a better idea as to where it would go next. In the world of currency trading, when someone says technical analysis, the first thing that comes to mind is a chart. Technical analysts use charts because they are the easiest way to visualize historical data. You can take a look at past data to help you spot trends and patterns, which could help you find some great trading opportunities. Next page, please. What more is that with all these traders who rely on technical analysis out there, these price patterns and indicator signals tend to become self-fulfilling. As more and more Forex traders look for certain price levels and chart patterns, the more likely that these patterns will manifest themselves in the market. You should know, though, that technical analysis is very subjective. Just because Ralph and Joseph are looking at the exact same currency chart setup or indicators. That doesn't mean that they will come up with the same idea of where the price might be currently headed to. The important thing is that you should understand the concept under technical analysis so you won't get nosebleeds. Whenever somebody starts talking about Fibonacci, Bollinger Bands, or pivot points, now we know you're thinking to yourself, geez, these guys are smart. They are crazy with words like Fibonacci and Bollinger. I can learn this kind of stuff. But nothing to worry about. After you're done with the school of mixology and understand everything about it, you'll be just as smart as every technical analysis you know. Next page, please. Fundamental analysis. This is a clear way of looking at the Forex market by analyzing economic, social, and political forces that may affect the supply and demand of an asset. If you think about it, this makes a whole lot of sense because just like in your economics 101 class, it is supply and demand that determines price, or in our case, the currency exchange rate. Using supply and demand as an indicator of where price could be headed is easy. The hard part is analyzing all of the factors that affect supply and demand. In other words, you have to take a look at different factors to determine whose economy is rocking like a Taylor Swift song and whose economy isn't doing well. You have to understand the reasons of why and how certain events like an increase in the unemployment rate affects a country's economy and monetary policy, which ultimately affects the level of demand for its currency. Next page, please. The idea behind this kind of analysis is that if a country's current or future economic outlook is good, their currency should strengthen. The better shape of a country's economy is, the more foreign businesses and investors will invest in that country. This would result in the need to purchase the country's currency to obtain those assets. In a nutshell, this is what fundamental analysis is like. You have the good economy, you have the bad economy. The good economy symbolizes or signifies high currency value, while a bad economy symbolizes low currency value. Next page, please. More on fundamental analysis. For example, let's say that the US dollar has been gaining strength because the US economy is improving. As the economy gets better, raising interest rates may be needed to control growth and inflation. Higher interest rates make dollar-denominated financial assets more attractive, and in order to get their hands on these lovely assets, traders and investors had to buy some greenbacks first, and as a result, the value of the dollar will likely increase. Later on in the course, you will learn which economic data points tend to drive currency prices and why they do so. You will know who the Fed chairman is and how retail sales data reflects the economy. You will be spitting out interest rates like baseball statistics. But for now, just know that fundamental analysis is a way of analyzing the potential moves of the currency through the strength or weakness of that country's economic outlook. It's of course going to be awesome. Next page, please. Now, earlier we discussed sentiment analysis. We understand that price actions should theoretically reflect on all available market information. Unfortunately for us Forex traders, it isn't that simple. The Forex markets do not simply reflect all of the information out there because traders will all just act the same way. Of course, that isn't how things work. This is why sentiment analysis is important. Each trader has his or her own option of why the market is acting the way it does. The market is just like Facebook, for instance. It's a complex network made up of individuals who want to spam our new feeds. Just kidding. The market basically represents what all traders, pip crawlers selling from the donut shop, feel about the market. Each trader's thoughts and opinions are expressed through whatever position they take. helps from the overall sentiment of the market, regardless of what information is out there. The problem is that as retail traders, no matter how strongly you feel about a certain trade, you can't move the forex markets in your favor. Even if you truly believe that the dollar is going to go up, but everyone else is bearish on it, there's nothing much you can do about it unless you're one of the G's, George Soros or Goldman Sachs, or the rest of them like that. Next page, please. As a trader, you have to take all this into consideration. You need to perform sentiment analysis. It's up to you to gauge how the market is feeling, whether it is bullish or bearish, and you decide how you want to incorporate your perception of market sentiment into your trading strategy. If you choose to simply ignore market sentiment, that's your choice. But we're telling you now, it's going to be a loss, because being able to gauge market sentiment analysis can be an important tool in your toolbox. Later on in school, we'll teach you how to analyze currency market sentiments and use it to your advantage. Next page, please. Throughout your journey as an aspiring forex trader, you'll be finding strong advocates for each type of analysis. Do not be fooled by these one-sided extremists. One is more and better than the other. They are all just different ways to look at the market. At the end of the day, you should trade based on the type of forex analysis you're most comfortable and profitable with. To recap, technical analysis is the study of currency price movements on the charts, while fundamental analysis takes a look at how the country's economy is doing, of course. Market sentiments analysis determines whether the market is bullish or bearish on the current or future fundamental outlook. Fundamental factors shape sentiments, while technical analysis help us visualize that sentiment and apply a framework to create our trade plans. Those three work hand in hand to help you come up with good forex trade ideas. All the historical price action and economic figures are there. All you have to do is put on your thinking cap and put on those analytical skills to the test. Next page, please. Still on which type of analysis is best for forex, we have those three legs too. Just to analyze it better, the importance of all three types of analysis. If you had to take out one of two legs of this two, and it's going to be shaky, right? Yes. In order to become a true forex master, you will need to know how to effectively use these three types of forex and market analysis, because they are all very vital. Next page. Let's take, for example, you're looking at your charts and you find a good trading opportunity. You get all excited thinking about the money that's going, and you spot a move on GBP USD. You love what the chart is showing you. It's picking a lot of money. Then you proceed to buy GBP USD with a big fat smile on your face. But wait, all of a sudden, the trade makes 100 pip move in the other direction. Little did you know, one of the major banks in London filed for bankruptcy. Suddenly, everyone's sentiment towards Britain's market turns sour and everyone trades in the opposite direction. Your big first smile turns into emotion. You start getting angry at your charts. You throw your computer on the ground and feeling it's pulverized. If you just lost a bunch of money and now your computer is broken. What I'm trying to say is this: fundamental and sentimental analysis work very importantly also. Next page, please. This is not based on real story. This is just what happens. Now, remember, you might have understood how back then forex usually being traded by only a few amount of people, but now a lot of people delve into it. Sentiments from different parts of the world. Don't just rely on one. Instead, you must learn the balance, the use of all of them. It is only then you can really get the most out of your forex trading services. Next page, please. Now, we are talking about types of forex charts. First, we have the line chart, and then we have the bar chart, then we have the candlestick, the most widely used. Now, we'll explain each of these Forex charts and let you know what you should know about each of them. Next page, please. For line charts, a simple line chart draws a line from one closing price to the next closing price. When strung together with a line, we can see the general price movement of a currency pair over a period of time. Here is an example of a line chart for Euro USD. You're seeing up and down movements like that. Next page, please. The bar chart is a little more complex. It shows the opening and closing prices, as well as the highs and lows. The bottom of the vertical bar indicates the lowest traded price for that time period, while the top of the bar indicates the highest price paid. The vertical bar itself indicates the currency pair's trading range as a whole. The horizontal hash on the left side of the bar is the opening price, and the right side horizontal hash is the closing price, of course. To the next page, please. Throughout the lessons, you will learn about bar charts. A bar is simply one segment of time, whether it's 1 day, 1 week, or 1 hour. When you see the word bar going forward, be sure to understand what time frame it is referencing. Bar charts are also called OHLC charts because they indicate the open, the high, the low, and the close for that particular currency. Now you see this, for example, high, low, open, close. The little horizontal line on the left is the opening price. The top of the vertical line defines the highest price of the time period. You see the little horizontal line on the right is the closing price, while the bottom of the vertical line defines the lowest price of that time period. So open, close, high, low, best understood this way. Next page, please. Candlestick charts show the same price information as a bar chart, but in a prettier graphic format. Candlestick bars still indicate the high to low range with a vertical line. However, in candlesticks charting, the larger block for the body in the middle indicates the range between the opening and closing prices. Traditionally, if the block in the middle is filled or colored in, then the currency pair closed lower than it opened. In the following example, the filled color is black, and for the filled block, the top of the block is the opening price and the bottom of the block is the closing price. If the closing price is higher than the opening price, then the block in the middle will be white or hollow or unfilled. So take into consideration this very important. This is a typical candlestick pattern. Down and up, we have the lower and the upper shadow. For the candle white, which is called the bullish, we have the low to the high, we have the open to the close. While for the red candle or the black candle, as the case is a bearish candle, we have the open from the top and the close down, the high from the top, low on the bottom. Next page, please. We don't like to use the traditional black and white candlesticks. They just look unappealing. And since we spend so much time looking at charts, we feel it's easier to look at a chart that's colored. A color television is more different than a black and white television. So why not splash some color on those candlestick charts? We simply substituted green instead of white and red instead of black. This means that if the price closed higher than it opened, the candlestick would be green. And if the price closed lower than it opened, the candlestick, of course, would be red. Next page, please. In our latest lessons, you'll see how using green and red candles will allow you to see things on the charts much faster, such as uptrend, downtrend, possible reversal points. For now, just remember that on Forex charts, we use red and green candlesticks instead of black and white, and we'll be using these colors from now on. So this is just a typical candlestick pattern that you'll be seeing on the chart, filled with the low and the upper shadows, the high and the lows, the open and the close points. Next page, please. trading channels. Importantly, if we take trend lines theory one step further and draw a parallel line at the same angle of an uptrend or downtrend, we'll have created a channel. We're not talking about ESPN, ABC, Cartoon Network, or the likes. We're talking about channel movements of Forex charts. For an uptrend, we're seeing a series of higher highs, higher lows. And for downtrends, we have seen series of lower highs and lower lows, as well as sideways trends as well. Next page, please. Channels are just another tool in technical analysis. They can be used to determine good places to buy or sell, both the tops and bottom of channels. They represent potential areas of support or resistance. To create an up ascending channel, simply draw a parallel line at the same angle as an uptrend line, and then move that line to positions where it touches the most recent peak. And this should be done at the same time you create a trend line. To create a down descending channel, you simply draw a parallel line at the same angle as a downtrend line, and then you move that line to a position where it touches the most recent value. This should be done at the same time you create a trend line. And when the prices hit the bottom trend line, this may be used as a buying area. When price hits the upper trend line, this may be used as a selling area. To the next page, please. These are the three important types of channels. We have the ascending channel, filled with higher highs and higher lows. We have the descending channel, filled with lower highs and lower lows. And we have the horizontal channel, which is ranging. Important things to remember about drawing trend lines. When constructing a channel, both trend lines must be parallel to each other. Generally, the bottom of channel is considered a buy zone, while the top of the channel is considered a sell zone. Like in drawing trend lines, do not ever force the price to the channels that you draw. A channel boundary that is sloping at one angle, while a corresponding channel boundary is sloping at another, is not correct and could not lead, or rather lead, to bad trades. Next page, please. How to trade support and resistance. Now we have known the basics, time to apply these basics but extremely useful technical tools in your trading, because we want to make things easy to understand. We have divided how to trade support and resistance level into two simple ideas, one called the bounce and the other called the break. Next page, please. The bounce. Just as the name suggests, one method of trading support and resistance level is right after the bounce. Many retail Forex traders make the error of setting their orders directly on support and resistance level and then just waiting for their trade to materialize. Sure, this may work at times, but this kind of trading method assumes that the support or resistance level will hold without price actually getting there yet. You might be thinking, why don't I just set an entry order right on the line? That way I'm assured that the best possible price, of course, would happen only and only if the price hits a particular price point which has been rejected. Next page, please. When playing the bounce, you need to tilt the odds in your favor and find out sorts of confirmation that the support or resistance will hold. You see the stop loss, you see the support, you see the entry order. Instead of simply buying or selling right off the bat, you wait for it to bounce first before entering. By doing this, you avoid those moments where price moves fast and break through support and resistance level. From experience, catching a falling knife when trading Forex can get really bloody. Take, for instance, the trend line resistance for a downward trend, hits the break, makes U-turn, and then puts a stop loss value. Next page, please. In a perfect world, support and resistance level would hold forever. McDonald's would be healthy and we would all have jetpacks. In a perfect Forex trading world, we could just jump in and out whenever price hits those major support and resistance levels and earn loads of money. The fact of the matter is this: the levels will break often, so if not enough to just play bounces, we should also know what to do. Whenever support and resistance levels give way. There are two ways to play breaks in Forex: trading the aggressive way or the conservative way. Next page, please. The aggressive way, which is the simplest way to play breakouts, is to buy or sell whenever price passes convincingly through a support or resistance zone. And the key word here is convincingly, because we only want to enter when the price passes through a significant support or resistance level with ease. We want the support or resistance area to act as if it just received a Chuck Norris karate chop. We want it to wilt over in pain as price breaks right through it. Next page, please. Why the conservative way? Imagine a hypothetical situation. You decided to go long to buy Euro USD, hoping it would rise after bouncing from a support level. Soon afterwards, the support breaks and you are now holding on to a losing position with your account balance slowly falling. One, either you accept defeat, you get out of the trade and liquidate your position, or you hold on to your trade and hope price rises up again. If your choice is the second one, then you will easily understand this type of Forex trading method. Remember, whenever you close out a position, you take the opposite side of the trade. Closing your Euro USD long trade or near break-even means you have to short the Euro USD by the same amount. Now, if enough selling and liquidation of losing position happens at the broken support level, price will of course reverse and start falling again. This phenomenon is the main reason why broken support levels always become resistance levels whenever they break. Next page, please. As you would have guessed, taking advantage of this phenomenon is all about being patient instead of entering right on the break. You wait for price to make a pullback to the broken support or resistance level and enter after the price bounces. This, for instance, you can see a downtrend and a pullback. Right after the pullback, you made an entry order, put your stop loss 10-15 pips away. Your take profits about 30 to 40 pips away. In Forex, this does happen all the time. Retests of broken support and resistance level do not happen all the time. There will be times that price will just move in one direction and leave you behind. Because of this, always use a stop loss order and never ever hold on to a trade just because of hope. Next page, please. When the market moves up and then pulls back, the highest point reached before it pulls back is now called a resistance. As the market continues up again, the lowest point reached before it climbs back is now a support. One very important thing to remember is that horizontal support and resistance level are not exact numbers. They help you filter out these false breakouts. You should think of them more or less like zones rather than concrete numbers. And one way to help you find these zones is to plot support and resistance on a line chart rather than a candlestick chart. Another thing to remember is that when price passes through a resistance level, that resistance could potentially become support, and the same could also happen with the support level. If the support level is broken, it could potentially become a resistance level. To the next page, please. So I think that's all for today on financial market literacy. See you again next week.